There is a moment in every financial cycle when a small, technical, almost bureaucratic decision reveals something much larger about the system underneath it. Most people miss that moment because it arrives disguised as paperwork. This is one of those moments. In the summer of 2025, a customs ruling buried in a letter from the United States government quietly reclassified something that had moved freely across borders for decades, and within hours, gold markets that rarely move more than 1% or 2% in a single session were surging toward record highs. If you did not hear about this, you are not alone. Most investors did not, but the people who manage sovereign wealth funds, central bank reserves, and multi-generational family fortunes noticed immediately, because what happened to Switzerland's gold trade was not really about Switzerland at all. It was a signal about where the global financial system is heading next. And by the end of this video, you will understand exactly why that signal matters more than almost anything else happening in markets right now. Before we go further, I want to ask you something, because your answer says a lot about where we are in this cycle. Comment below and tell me where you're watching from and whether you currently hold your savings in gold and silver or in cash. I read these and I want to see, city by city, country by country, how people around the world are actually positioning themselves right now, not how the headlines say they should be positioning themselves. There is real information in that collective answer, and we will come back to why later in this video. Let's start with what actually happened, stripped of drama, because the facts alone are strange enough without embellishment. On July 31st, 2025, the United States Customs and Border Protection Agency issued what is called a ruling letter. This is a fairly routine mechanism used to clarify how a specific product should be classified for tariff purposes. In this case, the ruling stated that 1 kilogram and 100-ounce gold bars, when imported from Switzerland, would now fall under a tariff code subject to the full 39% duty that the United States had imposed on Swiss goods more broadly. Until that letter, the market had operated for years under the assumption that refined gold bullion moving between allied trading hubs was exempt from this kind of tariff treatment. It was assumed, not written in stone, and that distinction between assumption and law is exactly where this story begins. To understand why this single ruling sent shockwaves through the gold market, you need to understand something most people never think about. Gold is not just a shiny metal that sits in a vault. It is a physical commodity that has to move constantly between hubs in order for the entire modern trading system to function. London is the historic center of the physical gold market, where bars are typically cast in 400-ounce sizes, each one about the weight of a brick. New York, through the COMEX exchange, is where gold futures contracts are traded and settled, but COMEX contracts are built around a completely different bar size, 1 kilogram or 100 ounces. Switzerland sits in between these two worlds as the great translator. Swiss refineries, names like Valcambi, Metalor, Pamp, and Argor Heraeus, take the large London bars, melt them down, and recast them into the smaller sizes that the American market actually needs. It is estimated that Swiss refineries handle somewhere around 70% of all the gold refined on Earth. This is not a small logistical detail. It is the connective tissue of the entire global bullion market, and for decades it has functioned almost invisibly because it worked so well that nobody had to think about it. Now imagine that connective tissue suddenly facing a 39% tax simply for doing what it has always done. That is effectively what the July 31st ruling threatened. Traders who had built their entire hedging strategy around the assumption that they could cheaply and quickly import physical gold into New York to settle COMEX contracts were suddenly staring at a completely different cost structure. Gold futures in New York spiked past $3,500 an ounce, a record high, as the market scrambled to reprice the risk that the physical bridge between London and New York was about to become far more expensive to cross. Within a day, the White House was calling reports of the tariff misinformation and promising a clarifying executive order. Roughly a week and a half later, President Trump posted directly that gold would not be tariffed, and futures pulled back from their highs. On the surface, it looked like chaos followed by resolution, a news cycle that flared and faded within 2 weeks. But here is the thing about moments like this: the resolution is rarely the real story. The real story is what the moment reveals about the system that produced it. And what this episode revealed, if you look closely, is a level of fragility and improvisation inside a market that most people assume is boringly stable. The United States did not sit down and deliberately plan to tax Swiss gold as a strategic maneuver. A customs classification decision made by officials focused on trade balances and tariff enforcement collided with a market that nobody in that room had fully modeled out. That is not a conspiracy. It is something arguably more unsettling. It is evidence that as trade policy becomes more aggressive and more improvised, it starts bumping into corners of the financial system that were never designed to withstand that kind of shock. Gold's plumbing was simply in the way. To understand why this matters so much right now and not 5 years ago, we need to step back and talk about the broader macroeconomic backdrop, because none of this happened in a vacuum. For the past several years, the United States has been running historically large budget deficits, even outside of recessions or emergencies, which is itself unusual. Government debt has climbed past $36 trillion, and the interest payments alone on that debt have become one of the largest line items in the federal budget, competing with defense spending and major entitlement programs. When a government has to borrow simply to pay the interest on what it already owes, economists call this a form of debt spiral risk. And while the United States is nowhere near a Greece-style crisis because it borrows in its own currency, the dynamic still shapes everything the Federal Reserve does. This is where interest rates come in, and I want to explain this in plain terms because so much financial commentary makes it sound more mysterious than it is. The Federal Reserve controls short-term interest rates largely to manage two competing goals: keeping inflation under control and keeping the economy from sliding into recession. When the Fed raises rates, borrowing becomes more expensive, which cools spending and eventually inflation. When it cuts rates, borrowing becomes cheaper, which stimulates spending and investment, but risks reigniting inflation if done too aggressively or too soon. This balancing act becomes far more difficult when the government itself is one of the largest borrowers in the economy. Higher rates mean higher interest costs on the national debt, which puts political pressure on the Fed to keep rates lower than inflation alone might justify. This tension between a central bank that is supposed to be independent and a fiscal reality that quietly pressures it toward looser policy is one of the oldest and most consequential dynamics in monetary economics, and it rhymes with periods going back decades. This is also where bond markets and liquidity enter the picture. Government bonds are in theory the safest asset in the world, the benchmark against which every other investment is priced. But when a government issues enormous quantities of new debt to fund persistent deficits, someone has to buy all of it. For years, foreign governments and central banks were reliable, steady buyers of U.S. Treasury bonds, in part because holding dollars and dollar-denominated debt was simply the safest, most liquid way to store national reserves. In recent years, that appetite has become less automatic. Some countries have deliberately diversified away from treasuries for their own strategic and geopolitical reasons. When traditional buyers step back, either the Federal Reserve has to step in and effectively create liquidity to absorb the difference, or bond yields have to rise to attract other buyers. Both outcomes have consequences. The first tends to be inflationary over time, and the second raises borrowing costs across the entire economy, from mortgages to corporate loans. This is the liquidity question that sits underneath almost every major market move you see today, even when the headlines are about tariffs or trade rulings. Now let's bring gold and silver into this picture properly, because they are not simply commodities that go up when people are scared. For most of human history, gold was money directly. Coins were often made of it, and paper currencies were, for long stretches, formally convertible into a fixed amount of gold. That changed decisively in August 1971 when President Nixon ended the direct convertibility of the U.S. dollar. From that point forward, the world's major currencies became what economists call fiat currencies, meaning their value rests on trust in the issuing government and central bank rather than on a fixed link to a physical asset. This was a profound shift, and it unleashed both tremendous flexibility for policymakers and, over the following decade, a period of significant inflation as that new flexibility was tested. Gold did not disappear from the monetary system after 19. It simply changed roles. Instead of being the anchor of currency, it became something more like an insurance policy against the mismanagement of currencies, and central banks themselves never fully stopped holding it. In fact, in recent years, central bank gold buying has surged to levels not seen in decades. According to World Gold Council data, central banks purchased more than 1,000 tons of gold annually in recent years, with 2025 seeing continued heavy accumulation, including more than 240 tons bought globally in just the first quarter alone. Surveys conducted by the World Gold Council have found that the overwhelming majority of central bank reserve managers expect their institutions to keep increasing gold holdings over the next year, with essentially none planning to sell. When the very institutions that manage national currencies are quietly and consistently accumulating gold, that tells you something important about how they privately assess the risks in the system they officially oversee. They are not buying gold because they expect the dollar to collapse overnight. They are buying it because gold does not carry the credit risk, the political risk, or the currency debasement risk that a bond issued by any single government inevitably carries. It is, in the language of economists, a reserve asset with no counterparty. This is the deeper context in which the Swiss gold tariff episode needs to be understood. Switzerland was not targeted because of some hidden plan to punish it specifically for its role in the gold trade. Switzerland was caught in the machinery of a much broader trade policy built around large, across-the-board tariffs designed to address bilateral trade deficits, and gold simply happened to be one of Switzerland's largest exports to the United States, worth tens of billions of dollars annually. But the fact that this machinery could so easily catch something as sensitive as the physical plumbing of the global gold market, almost as an afterthought, is itself the signal worth paying attention to. It shows how aggressive trade policy pursued for domestic, political, and economic reasons can create ripple effects in the monetary system that were never the primary intention, but which matter enormously to anyone holding gold, silver, or currency as a store of value. Let me pause here and bring this down to a human level, because macroeconomics only matters if you can see how it plays out in real decisions. Consider someone we'll call Daniel, a 44-year-old small business owner in Ohio. Daniel had spent 15 years building a modest manufacturing supply company, and by his early 40s, he had around $200,000 in savings, sitting mostly in a checking account because he associated the stock market with the volatility he had watched destroy his father's retirement account in 2000. When gold prices surged past $3,500 an ounce during the tariff scare, Daniel panicked in the opposite direction. He liquidated a large portion of his cash into gold coins within a single week, right near the peak of that short-term spike, driven purely by fear that he was about to miss the move of a lifetime. When the White House clarified the tariff situation and gold pulled back from its highs, Daniel found himself sitting on a paper loss and, more importantly, a portfolio with zero diversification, all concentrated in a single asset he had bought in a moment of emotional urgency rather than considered strategy. Daniel's story is not a story about gold being a bad investment. It is a story about the danger of making binary, all-in decisions based on a single headline, rather than treating gold as one component of a broader, deliberately constructed plan. Now consider a very different story. Someone we'll call Mailing, a 31-year-old software engineer in Singapore. Mailing had read about central bank gold buying trends over the previous 2 years and had gradually built a position representing about 8% of her total savings, adding to it slowly in small amounts roughly every quarter, regardless of what the price was doing that week. When the Swiss tariff news hit and gold spiked, she did not buy more and she did not sell. She simply continued her existing plan because her allocation had never been designed around predicting short-term news events. It had been designed as a long-term hedge against currency and policy uncertainty, sized appropriately so that even a sharp move in either direction would not meaningfully derail her broader financial life. A year later, whether gold was higher or lower than that particular spike mattered far less to Mailing's overall wealth than it did to Daniel's, precisely because she had never made the mistake of treating a single news cycle as a referendum on her entire strategy. And one more story, because this lesson deserves reinforcement from a different angle. Consider Robert, a 67-year-old retired teacher in the United Kingdom who had spent 30 years methodically saving into a pension and had never owned a single ounce of gold or silver in his life, dismissing precious metals as, in his words, a hobby for people who distrust everything. When inflation eroded the real value of his fixed pension income over several difficult years, and he watched the purchasing power of his monthly payments quietly shrink even as the number on the statement stayed the same, Robert began to understand, somewhat late, why previous generations had insisted on holding some hard assets as ballast against exactly that kind of erosion. He did not swing to the opposite extreme. He made a measured decision, with the help of a financial advisor, to allocate a modest single-digit percentage of his overall retirement assets to physical silver and a small gold position, not as a bet on a crisis, but as a permanent piece of insurance he wished he had held for the previous 2 decades. Robert's story illustrates a different kind of lesson. The cost of having zero exposure to monetary hedges is not always a dramatic collapse. It is often a slow, almost invisible erosion that only becomes obvious in hindsight. These 3 stories point towards something important about investor psychology, and this is where it helps to understand a little bit about the biology underneath our financial decisions, because none of this behavior is irrational in the way it feels from the inside. When markets move sharply, whether gold spiking on a tariff headline or stocks plunging on a rate decision, your brain does not experience that primarily as a spreadsheet problem. It experiences it as a threat in almost the same way your ancestors' brains experienced the sudden appearance of a predator. The amygdala, a small almond-shaped structure deep in the brain, triggers a fast, largely unconscious fear response, flooding your body with cortisol and adrenaline before your more deliberate analytical prefrontal cortex has even finished processing what happened. This is why panic buying and panic selling happen so fast, and why they so often happen at exactly the wrong moment, near the peak of a spike or the bottom of a crash. Your nervous system evolved to respond instantly to physical danger, not to rationally evaluate a customs ruling on gold bar classifications, and it does not distinguish well between the two. On the other side of that coin is greed, which operates through a different but equally powerful mechanism, largely mediated by dopamine, the brain's reward and anticipation chemical. Interestingly, dopamine spikes most sharply not when you actually receive a reward, but in anticipation of one, which is part of why the fear of missing out is such a potent force in financial behavior. Watching an asset rise rapidly while you are not participating triggers a genuine neurochemical discomfort almost identical to the craving response studied in addiction research, and it is precisely this mechanism that pushed someone like Daniel into an impulsive all-in purchase near a short-term peak. Understanding this is not about excusing bad decisions. It is about recognizing that discipline in investing is not simply a matter of intelligence or knowledge. It is quite literally a matter of building systems and rules that protect you from your own neurochemistry during the exact moments when that neurochemistry is working against your long-term interests. Before we go further into what this all means for how you think about your own portfolio, I want to ask you to do two quick things because the final part of this video ties everything together and I think you'll want to see it. If you're finding this kind of grounded, evidence-based breakdown useful, take a moment to like the video since it genuinely helps more people find analysis like this instead of the sensationalized noise that usually surrounds gold and monetary policy. And if you haven't already, consider subscribing because we walk through exactly this kind of structural, follow the evidence analysis regularly. Stay with me here because the final insight of this video connects the tariff episode, the central bank buying trend, and the psychology we just discussed into a single conclusion that I think is genuinely one of the more important things you can understand about markets right now. Let's talk about currency strength and weakness because this is the piece that ties the Swiss gold episode directly back to something every single person watching this experiences in daily life, whether or not they own a single ounce of gold. A currency's strength is not some abstract number on a trading screen. It reflects in aggregate global confidence in the economic and fiscal management of the country that issues it. When a government runs persistent, large deficits, when its central bank is under political pressure to keep interest rates lower than inflation alone would justify, and when its trade policy becomes more unpredictable and aggressive, all of these factors chip away gradually at that underlying confidence. This does not happen overnight, and it rarely happens in a straight line. The dollar can still strengthen for months or years at a time, even while these longer-term pressures build, because currency markets respond to dozens of competing forces simultaneously, including relative growth rates, relative interest rates, and global risk appetite. But the long-term trajectory of a currency is, in the end, a referendum on trust. And that trust is exactly what gold and central bank reserve managers are quietly pricing in when they choose to hold more bullion and fewer government bonds. This is where geopolitical risk enters the picture as well, and I want to be precise here rather than dramatic. The imposition of a 39% tariff on one of the world's oldest and most historically neutral trading partners is not by itself evidence of an imminent crisis, but it is evidence of a broader shift in how major economies are choosing to relate to one another, moving away from the assumption of frictionless, predictable trade that defined the post-Cold War era, and toward a world where tariffs, export controls, and trade rulings can appear with very little warning based on domestic political priorities rather than long-negotiated international agreements. Gold has always performed a specific function during periods like this because unlike a bond or a currency, its value does not depend on any single government honoring its obligations. It is not somebody else's liability. That is precisely why throughout history, gold demand tends to rise not necessarily during the worst crises, but during the uncertain transitional periods when investors and institutions are not yet sure what the new rules of the game will be. There are useful historical parallels here, and I want to walk through them carefully because history does not repeat exactly, but it does rhyme in structurally similar ways. In the 1970s, following the end of dollar-gold convertibility, the United States experienced a period of high and persistent inflation compounded by oil price shocks and a Federal Reserve that was initially slow and inconsistent in its response. Gold, which had been fixed at $35 an ounce for decades, was suddenly allowed to trade freely, and it rose dramatically over the following years as investors sought protection from currency debasement and negative real interest rates, meaning interest rates that were lower than the inflation rate, effectively punishing savers who held cash. That period ended only when the Federal Reserve under Paul Volcker was willing to raise interest rates dramatically, even at the cost of a painful recession, to fully restore confidence in the currency. That episode teaches an enduring lesson. Gold tends to perform strongly precisely during periods when real interest rates are low or negative, and when confidence in a central bank's commitment to fighting inflation is in question. The 2008 global financial crisis offers a different but related parallel. In that case, the shock originated in the banking and housing system rather than in currency or fiscal policy, but the response, massive liquidity injections and near-zero interest rates sustained for years, again created an environment of low real returns on cash and government bonds, and gold rose substantially over the following years as investors sought an asset that did not depend on the health of the banking system or the solvency of any particular financial institution. What both of these historical episodes share with the current moment is not identical circumstances, but a common underlying structure. Periods where the tools policymakers are using to manage debt, growth, or geopolitical tension create side effects that quietly erode the appeal of holding pure paper assets and correspondingly increase the appeal of an asset that has functioned as a store of value across every currency regime in recorded economic history. So where does this leave us, and what is the single insight I want you to walk away from this video with? It is not that a crisis is imminent, and it is not that gold is guaranteed to keep rising in a straight line, because no honest analysis can promise that about any asset. The insight is this: the Swiss gold tariff episode was a small, almost accidental crack that briefly exposed the seams of a much larger system, one defined by heavy government debt, a central bank managing an increasingly difficult balancing act between inflation control and fiscal reality, a more unpredictable global trade environment, and a world where the institutions best positioned to see all of this clearly, the central banks themselves, have been quietly and consistently building larger gold reserves for years, not as a bet on catastrophe, but as a rational hedge against exactly the kind of structural uncertainty this episode revealed. When the people who understand the plumbing of the global financial system best are consistently choosing to hold more of an asset that carries no counterparty risk, that is not a secret, and it is not a conspiracy. It is simply evidence sitting in plain sight in publicly available World Gold Council data and central bank reports, available to anyone willing to look past the headline of the day and ask what the underlying behavior is actually telling us. What should you actually do with this information? Not panic, and not make a single dramatic move based on this video or any other piece of content you watch this week. The lesson from Daniel, Megan, and Robert is the same lesson history keeps teaching in different forms. The investors who do best over long periods of time are rarely the ones who react fastest to a single headline. They're the ones who understand the structural forces at play, who size their exposure to hedges like gold and silver as a deliberate, sustainable part of a broader plan rather than an emotional reaction to a spike, and who treat volatility in either direction as information rather than as a command to act immediately. Precious metals have functioned as a form of financial insurance for thousands of years precisely because they do not require you to correctly predict the timing of the next tariff ruling, the next Federal Reserve decision, or the next geopolitical shock. They simply exist as a hedge against the possibility that paper promises, however well-intentioned, sometimes fail to hold their value the way we assume they will. We are living through a genuinely unusual period in monetary history, one where old assumptions about frictionless global trade, stable currency relationships, and predictable central bank behavior are being tested in real time, and where events as seemingly small as a customs classification letter can offer a genuine window into much larger forces. My hope for you watching this is not that you walk away anxious, but that you walk away more informed and more capable of separating the signal from the noise the next time a dramatic headline crosses your screen. Stay curious, stay skeptical of both panic and hype, do your own research from primary sources rather than secondhand alarm, and build a financial plan that can weather uncertainty rather than one that depends on you correctly predicting every twist and turn of a system this complex. That, more than any single trade or any single asset, is what genuine long-term wealth preservation has always actually required. And it is available to anyone willing to think clearly, patiently, and independently, regardless of what the headlines say tomorrow.